Good morning and welcome this morning to Trading Futures. There's the bell. That means the cash market's off and running. We're going to see how that is going to pay attention to what's been going on in the futures market. We'll see how that plays itself out. By the way, my name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. And you are joining me and Michael Fairborn out there in the chat. Mike, a 20-plus year veteran of the financial markets, here to help out in answering your chat questions along the way. Welcome to all of you, whether you're here with us live or in the recorded version. Leave us a comment, leave us a question out there in the chat, and we'll get to those. Now, we're going to talk about a couple of things going on in the market today. We're going to get to a trade here, a trade example very quickly, and then we'll break things down. And I've got a couple of things I want to talk about when it comes to what's going on in the energy space. So we'll see what that means as we get into the discussion here really quickly. And couple of quick housekeeping items that we need to take care of. First and foremost, remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation of any particular strategy or idea or particular instrument. Remember that futures and futures options trading involves substantial risk. It is not suitable for all investors. Make sure that you're aware of the characteristics of risks of standardized options. Remember that to read the risk disclosure statement for futures and options prior to trading futures products. And remember, the futures trading requires separate trading authorization, so be aware of that. And keep in mind all of those characteristics, and we'll talk about some of those of futures trading. Now, remember, we're going to be using the Thinkorswim desktop software platform today. It is not a guarantee of future success out there in the real world. Specifically, we're going to be using the paper money version of that. And again, it's a great playground to learn, but it doesn't guarantee future success out there in the real world. Also, along the way, we're going to be using a lot of technical analysis. That's not the only way to look at the market. All of the ways that we might analyze the market are theoretical. None are guarantees as to what might happen. Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Now, if we do happen to use and look at virtual currency futures markets, remember that they involve unique and significant risks. Be aware of those risks. Make sure that you pay attention to the NFA investor advisory and the CFTC customer advisory on those products if you're going to consider trading those products. One other note that I'm going to mention, we'll talk about it as we get into the discussion. Remember that stop orders behave differently for futures than they do for equities. We may issue a stop market order. That market order is going to be worked as an exchange designated limit order based on their protection points. So there is a possibility that those stop orders might not get filled. We'll talk about some of the special circumstances of that as we get into this discussion here this morning. I want to pop really quickly out to our Thinkorswim desktop software paper money platform here. And I want to take a look at, first of all, what's going on in the interest rate market. This is /10Y. And I want to just jump right into this trade, and then we'll break it down. But this is the interest rate yield, if you will. This is what effectively is referred to as the interest rate, right? When you think about bond price drives yield. They move inversely from one another. So if bond prices are going up, rates are going down. And that's kind of what we have been seeing happening here this morning over on this right-hand side. This is a today's trading 5-minute chart. Each one of these candles represents 5 minutes of trading, and you can see what's going on with the interest rate at the moment. So if we think about it, we're gonna equate this to what is kind of expressed as the interest rate based on these interest rate futures. Now, this isn't the bond market. We're not buying and selling the bonds. We would be looking at trading the futures on interest rates. So speculative movement on interest rates. So we can see that that is at the 4.335 level. That would mean the equation, the kind of comparison here is that interest rates currently would be in that 10-year rate, 4.33%. So if a trader is mortgage sensitive or credit card rate sensitive or auto loan sensitive, this has some particular interest. Now it's been moving to the downside. We saw a break below kind of this support level, which was a previous resistance. We can see on the 1-year chart that the interest rates have kind of been coalescing and squeezing into this, what I sometimes refer to as a milquetoast ascending triangle, but it's kind of running into this area where rates have pulled back. They've rallied back up. We talked a little bit about this from the context of this maybe being the right-hand shoulder of a larger head and shoulders type of reversal. And we're seeing some resistance coming in here right around that 4.34, 4.35 range. And you can see where that level equates to, 4.342. And our first candle below that now just closed below that level. So what we're going to do is we're going to take a look at trading this as an example trade below that level. So our first initial move here is down below that level. We're going to look for this to make that move down to a level of support. So on the daily chart, the intraday chart, the today's 5-minute chart, looking for maybe a move down here to that 4.32 level, maybe even a little bit lower. That's kind of where that reversal happened, and we're starting to see it. And I'm talking too much already, but I want to zoom in over here on the right hand or on the left hand side to kind of see where that level might equate to. We might look for this to move all the way down to the bottom of this triangle once again, maybe down to this 4.25. So that's actually where I'm going to use as a target, is at that 4.25 level. Now, there's no guarantee the price is going to go here to that level that I've drawn in. That simply is a previous level of support that we saw a bounce from. It could move higher. And so if it does move higher, I want to know where a trader might take that trade off, or might look at taking that trade off, and that might be at the 4.4 level, which is just above. And we might even take that a little bit shorter and say take that trade off above, if it goes back up above this intraday high, which was really kind of this point right here, that 4.36 level. So we can use that as our short-term take the trade off point at which we would think about exiting the trade. Now, this is going to be a trade that is not a set it and forget it. No trade is or should be a set it and forget it trade. Certainly not an intraday interest rate futures trade, given the potential risk. And I don't want to downplay the risk here in this particular case, but let's put this trade on. And I'm going to put this trade on with an OCO bracket order. Now, one of the things that is important to remember, that in the futures market, because this market can move quickly one side or the other, and because those orders might get worked as exchange driven and exchange worked limit orders, there is the potential that both sides of this order could get hit and filled. So that is a concern. And again, that's one of the reasons why we want to pay attention to this trade on an ongoing basis. That is a circumstance that can occur. It's a slim likelihood, right? The probability of that happening is slim, but it is a potential. So we're going to create this trade. We're going to go short the /10Y futures, and we'll talk through this trade as we build it. And see, we get that little bit of a candle right there popping back up. Now that candle's still in motion. So here's what we're going to do. We're going to enter right here at about this 4.336 mark, right click, sell custom with OCO bracket. And we're going to create this order to get into the trade, make that move to the downside, theoretically, right? So sell it, but buy it back if it goes up to 4.36, or buy it back if it goes down to where we said that target might be around 4.26. So 10 points, or 0.10 up, 0.10 down, and we'll see if that plays itself out here. So we're going to look at taking this trade off if it goes down to, we're going to say, fine, limit price. This is going to be a limit order, 4.26. That's going to be our order to take this off if it goes in the direction that we expect it to go, right? And we're going to make that a day order. And if we now go the other direction, our exit is going to be up here at 4.36. So we're just going to type that back in, 4.36. And that's going to be a stop market order, but not really. Because remember, if we put it in as a stop market order, that market order doesn't get worked as a market order. It doesn't fire off as a market order. It goes to the exchange. It gets worked as an exchange-driven limit order within their protection points. There is a possibility, even with this being a stop market order instead of a stop limit, that order could get gapped around or could end up not being filled at all. So we want to pay attention to that in this particular case. And so we're going to go ahead and we're going to create this order. We can see that that's starting to climb a little bit here. And that's okay. We can sell a little bit higher in this particular case, but we're going to go ahead and click on confirm and send. We're going to put this in our futures group. We're going to read through this order. Now, remember, this is an order that has an exchange transaction cost, an exchange-driven transaction cost. So we've got to be aware of that. And we've got to be aware of the potential risk in this particular trade in terms of our initial margin and then potential maintenance margin. Now, theoretically, this trade is going to be a one-day trade that we're going to have this trade on. We're not going to hold this trade through those overnight hours where that mark to market happens. We might have to adjust to and deal with our maintenance margin. But here's where we're looking for that trade to move. And we're going to put this trade on. We're going to set it off into that futures group. Again, this is an illustrative and educational example. This is not a live trade. You can see that right here, simulation, not a real trade. So I'm going to go ahead and I'm going to click on send, and we're going to fire that order off. And we got filled at 4.336. And we're looking for downward movement on this particular trade. So now, I happen to notice, speaking of that, we've got a feedback survey out there in the chat. Do me a favor. Michael Fairborn is going to pin that up to the top of the webcast, the chat function there, but help me make this session better. Click on that survey. Take a moment to do that. Either click on it now and set it aside, or click on it and fill it out right now. But that's going to be helpful for us making these sessions better going forward into the future. And you guys have already been phenomenally helpful. And if you filled it out before, fill it out again. We'd love for you to do that. Also, the other thing to do, if you wouldn't mind, is click on that subscribe button down there in the lower right-hand corner of the screen. That subscribe button is going to connect you to the Trader Talks webcast channel. That's going to keep you connected to the Trader Talks webcast community. And it's going to help also to pop this content up to the top of your YouTube feed, as well as the top of other people's YouTube feeds. So it helps you, helps other people, and it's at no cost to you. And it's a helpful subscription. The other thing that I would ask you to do, and Michael, I think, has talked about this as well, you can follow us on X. At Ben Watson CS is my X handle. At Michael Fairborn CS is Mike's handle. And the potential here is, you get to see some cool stuff that Mike and I post, and our other education coaches as well. So it's a good reason, good opportunity for you to stay connected with us as well. All right. So Martin asks a great question, the profit and loss of this potential trade. So let's take a look at this, right? So if our exit here is at 4.36 on the upside, and our exit on the downside is at 4.26, and we got into the trade here at 4.335, right? Our expectation is downward movement, and we're starting to see that downward movement. Let's go back over to the trade here and take a look. I'm going to go to the monitor tab, and I'm going to go to my futures group, and we're going to open this up. All right. So the expectation is, in this particular case, that we're going to see that downward movement, and it's working in our particular favor at the moment, right? It's going in the direction that we want it to go. The potential for loss in the trade. Let me go back here to the chart, and I'm going to open up this right-hand side as we talk through this. I'm going to just kind of squish this back down so that we can kind of see those areas, right? And I'm going to squish down the range here. So here's the range. Let's kind of draw this in, and I think this is a phenomenal question, in terms of risk to reward in this potential trade, right? Or theoretical risk to reward, because again, we can't specify exactly what that risk is going to be. We can quantify it, but again, we've got to monitor this trade and be attentive to this trade. We can't just set it and forget it and say that's the risk, and we put our orders on there and we're just going to let it go. So we're going to watch this. But here's the thing. If this is our risk, here's where we got into the trade. It was right there. So this is risk, right? And if our take profit order, if you want to call it that, right? Theoretical take profit order is here at 4.26, right? So then what we're looking for is a move down to this level. So just kind of make this visual, because I know we've got a lot of visual learners out there, right, in terms of the profit and loss on this trade. So this is the distance that we're looking for our potential risk. I'll make that RI. And this is our potential return. I'll make this R little e, return, right? Risk versus return on the trade. That's our potential for this trade. And so if this works in the favor of our directional movement, if what we expect happens, which is a move to the downside here in this /10Y futures product, which is that interest rates are going down, then that's what we're looking for to pick up in this particular trade, right? So we can quantify what that is numerically, but I like the way that we can kind of put this in terms that visual perspective here. So risking less than we stand to make in the trade, but again, we got to be vigilant in paying attention to those risks, because this is it hasn't, and typically at this particular time in the day, this is kind of when it starts to pick up and move again a little bit, as we're going to get into things like those bond markets, the cash bond market beginning to move. That's going to have an impact here on interest rates. Also, news flow throughout the day is going to have an influence here on interest rates as well. And so our expectation is that downward movement. So I hope that kind of helped to visualize what the expectation was or is for this particular trade. We're looking for that continued downside movement, and we're willing to take that downside move off if it doesn't go in our favor, right? If it doesn't continue to go in our favor. So we're going to pay attention to where that is. And because remember, kind of balanced against that is that previous resistance level that we saw on the longer term chart up there just above the 4.4 mark. And that would kind of be an equidistant trade. So yeah, we can put in terms of this dollar value of the risk to reward in this particular trade. So let's do that, right? So 4.26, let me kill my annotations here real quick. Or actually, let me go over here and we'll do this. So we'll say, look, we got into the trade. Let me put up my calculator. We got into the trade at 4.336, right? Let's just make sure. Our trade price was 4.336. Okay, 4.336 in this particular case. Okay, and we stand to lose in the trade, right? We said our exit price. Let's go to our working orders here and see where our exit was 4.36. So 4.336, let's just do the math here. 4.36 minus 4.33 is 0.03. So keep that in mind. We'll just kind of put this in place here. 0.03 point move in the futures contract. So we'll continue the conversation here and kind of carry this out. 0.03 risk. Now, our return in the trade, we said, was 4.26, 4.36. So let's do that. So 4.3 minus 4.26 to 6 is 0.07, right? 0.07 return. Okay, now we know what that is, right? 0.3 risk, 0.07 return. Point move on the contract, right? Now let's see what that equates to in dollars as we go into this discussion. So let me kill my annotations, which don't mean anything now that we have what those refer to. So now let's go back to our charts and let's go back to our other futures grid. Okay. So what is our tick size, right? It is 0.001. And what's our tick value? It is 1.0. So each point worth $1,000, right? That's our contract specification. So let's see, how many ticks would be this 0.3 to 0.7, right? Or 0.3 risk, right? If our tick value or tick size is 0.001, that's going to be, so let's see if I can do the math correctly here. 0.03 times 0.001. Nope, that's not it. It's divided by, right? 0.03 divided by 0.001. That'd be 30 ticks, right? Okay, so 30 ticks times $1. 30, right? That makes sense. So do we have a point value move? We don't. So let's do this. Let's take that $1,000. That's our point value. 30 ticks. That's not quite a point, right? So a point move would be 4 to 5, right? We're not seeing that. So $1,000 divided by 0.30. All right, I'm getting messed up in the math here, but it would be 30% of that, right? So of that $1,000. Now, the other side of that coin, our potential gain, we can go through the same thing, right? So 0.7 times our tick size times our tick value. So $30 minus what, 70? Yeah, so $70 of potential profit to $30 or $30 of potential risk in the trade in terms of the math. It's early to do math, guys, right? Okay. All right, let's take a look at what's going on here in the futures market broadly. I want to pop back over here to the YFT futures grid. There we go. And we're going to take a look at the Russell 2000. We can kind of see that it is bouncing down from that resistance level. We talked about this the other day. We talked about the fact that we were seeing a little bit of neutral movement in the Russell 2000. We're seeing a little bit more bullish movement in the S&P 500 and the /ES movement. And we're seeing a little bit of bullish movement in the NASDAQ, kind of running up against that resistance level, in this case, of the 200 period moving average. So still some bullishness, a little bit of neutral movement. Now, one of the areas, though, that I happen to see a bit of kind of sideways movement with some potential downward move was /CL. This is in the crude contract. And upward, maybe running into a little bit of a resistance here. So I wanted to pop this into our future movers grid. And by the way, I've shared this grid a couple of times. My thought was, this was the other trade that I was looking at potentially putting on early this morning and early in this webcast, was this breakout of the resistance level on, that's gold, /MCL. Let's make sure we're on the right one. There we go. All right. So this is crude and running into that resistance level, kind of banging its head on this resistance at the 69 mark and building into that symmetrical triangle. So the idea being that if we got a breakout of the symmetrical triangle looking for an upside move, and if we get a move back down, potentially that move back down takes it to the bottom of this symmetrical triangle. And that's the direction that it seems to be going. But what I think, we might see happening here, because there is a little bit of upward pressure we can see in this short term. This is, again, the today's trading 5-minute chart. is this potential move to the upside on a breakout of that ascending triangle, right? So a breakout of the ascending triangle may move this price higher. So here's the thought that I had in terms of putting this particular trade on is I could, in going back to technical analysis as a perspective here, could go to the absolute base of this triangle, kind of the first definition of this move, which was this range to here, right? But I don't want to do that. I want to attenuate this somewhat. And I want to say, look, let's take it from here, this kind of first real bounce in this ascending triangle from 69.41 to the resistance here at 69.64. And I want to take that level, duplicate it, and I want to put it up here on the top of this triangle. So if we do get a breakout to the upside, I know where my target is. And likewise, if we get a move down to the downside, I know where I want to potentially take the trade off. It would be breaking below the bottom of this triangle, right? Yeah, thank you, Silas. Thank you for doing the math for me and coming up with my overcoming my shortfalls this morning. Thank you, Silas. I appreciate it. Okay, math is hard. No, it's not. But it's hard in the morning sometimes. Did I ever tell you the story about the fact that my dad is a biostatistician, and growing up, he tried to teach me statistics, he tried to teach me math, and he and I butted heads on that all the time, like all the time. So I got to the point where I kind of hated math originally because of that butting heads, but then I end up using statistical math every single freaking day of my life. So you just look, if you still have the opportunity to learn from your parents, listen to them. Just saying. And I do. I mean, I still talk to my dad, and we talk about futures, and we talk about trading and stuff, and that's cool. And I tell him all the time. That I wish I had listened to him. And see, of course, somebody says math is easy. It is, for sure. I wish I had listened to him more when I was a kid, though, because then it probably would have sunk in more. All right. So here's my thought on this particular trade. I want to put in a trigger on this trade above this resistance level, right? And I want to make this a conditional order. Now, remember, conditional orders, normally, when we put in a conditional order on an equity, we put in a conditional order that says, hey, if price breaks above this level or if price breaks below this level, then enter the trade on a market order. And we accept that next available price. But we know that market orders get worked by the exchange. So there's a possibility when we're talking about futures contracts that order doesn't get filled. And so that's kind of one of those characteristics of these trades that we need to pay attention to. But let's build this as a market order. We'll do an OCO bracket, but we'll trigger it with a conditional order as opposed to, let's say, for instance, a buy stop. Now, we could do either one. We could do a buy stop. And it's going to accomplish the same kind of thing, right? But let's put this on with a conditional order so we can see how this is constructed. The condition is going to be, if price breaks above 69.64, then enter the trade, else wait. And if we get into the trade, then take it off if we get below 69.53, or take it off if we get up to 69.87, right? That's going to be our conditional, or our bracket order. So we're going to do this. We're going to come in here. We're going to right click, and we're going to do buy custom with OCO bracket. Okay. So normally this is going to be set out as a limit order, but we're not going to do that. We're going to go over here to this right-hand corner, and I'm going to click on that little gear icon. Okay. So I know that my breakout level that I want to get into the trade 69.65. And so I want to say, all right, fine. Because if I just set this as a limit order, it'll buy it anywhere under 69.65 because that limit says, wait, that's the most I'm willing to pay. So I want to be above that level before I get into the trade. So I'm going to click on the gear icon, and I'm going to bring up my order rules box. And I'm going to say buy it at a market order. But we know that that's not going to be a market price. That's going to be an exchange-driven limit price based on those protection point rules, which we've talked about before, but I wanted to reiterate again. And we're going to say, fine, if this contract marks at or above 69.65, right? 69.65 was our threshold. 69.65. Okay, that's our threshold, and we're going to go save. Now that conditional is in place, and you can see that that little gear icon is persistent in that column right now. So that now becomes our entry point into the trade, and it's going the other way. But it's coming down to that where we might see a bounce off of that support level. But now let's put in the other parts of the trade. We're going to take the trade off. We're going to sell it if it gets up to 69.87. So that's this first order right here. So again, 0.87 is our take the trade off point. And again, that's going to be a limit order. So that's going to limit order in that particular case is going to be a limit order. It's going to say, hey, get me out of the trade if I can get out of the trade at 69.87 or higher. And if it moves up, if it gaps up, higher is going to be better, right? And then the other side of the trade is what it's just blown through in this candle, right? And that was our stop here at 69.54. So we can still put this order in, right? Because, 54 is our stop. Now, that candle hasn't closed. It's going the opposite direction. We're going to wait and see, because here's the thing. This order is not going to fill until that price moves up. So even if our original objective was that upward movement, and we're starting to get this one candle that's tailing off to the downside, we can still put this order in place, knowing that we've got that conditional right there, as opposed to just setting that out as a limit order, which would get us into the trade down here. And if it continued to move against us, that would be putting, kind of getting us into that scenario. But notice what's going on with this candle. It's starting to tail off a little bit into a bit of a hammer-like candle. So we're going to go ahead and I'm going to stop talking, and I'm going to put this order out in place, and we're going to put this in our futures group. Again, making sure that we're aware of any characteristics and issues that we need to pay attention to, and any alerts, recognizing that there is going to be an exchange mandated transaction cost here, and we're going to go ahead and we're going to click on send. Again, we're waiting for this to come up above that resistance level to get into the trade. So now that trade is in place, not filled yet, but we get that big hammer-like candle. That could be a bullish indication, right? Now, here's the other thing I wanted to show you today, because one of the things that I'm going to go to my single grid here really quickly. One of the things that that we've talked about before is the way that you can use futures markets and futures contracts as a measurement of what's going on elsewhere in the market, right? So I want to do this. I want to look at /HO for just a second. This is heating oil. And heating oil is two things. One, it is the usage of heating oil by consumers to heat homes and businesses, and it's used in industrial purposes. But this is also largely a proxy for two other things. It is a proxy for jet fuel and diesel fuel, right? Hey, TNX is at 43.23, so going in the direction that we thought it was going to go, right? All right, so looks like maybe our trade, we'll have to come back and take a look at that. Let me get through this and we'll come back and look at that trade, Carol, real quick. Now, TNX, again, is going to be different than /10Y, so we'll see what that looks like. But here, let's take a look really quickly at heating oil. This is a proxy for jet fuel. When jet fuel prices are rising, that's generally an indication of demand, right? And when there's demand, that indicates that airlines, I'm going to look at an airline symbol here. Remember, all of these symbols that we're looking at simply for illustrative and educational purposes only. So I'm going to look at UAL. And one of the things you notice that this tends to kind of track with what heating oil is doing. There's a reason for that. If we do this, I go to studies, add study, compare with custom symbol /HO. Generally, and the correlation is there. You can kind of see it's a general correlation, but take a look at this. As airlines were coming down, demand was decreasing for heating oil, i.e., jet fuel. Now that airlines starting to turn back up, heating oil demand, i.e., jet fuel, starting to pick back up again. So this heating oil can be an indication, kind of a proxy for what's going on in the airline space, which by and large can be used as a proxy for consumer demand, if you will, for consumer buying sentiment in a lot of cases. So heating oil isn't just heating oil. It is a proxy for what's going on in the airline space. And that's kind of what I wanted to bring out. Now, there's one other way, potentially. I'm going to go back up here to my Flask icon. I'm going to take off that comparison line. I'm actually going to take off that ADX for just a second, just to kind of clean this up a little bit. So now we are in United. But let's go to / heating oil again. This is / HO. As that's starting to go up, and we plot against that, let's go to our ad study, compare with custom symbol / CL, what we just traded in crude oil. You can kind of see that these move generally in lockstep with one another, but they don't move exactly in lockstep with one another. And here's the thing, the difference between, for the refiners, the companies that refine the jet fuel and the diesel fuel and the heating oil out of crude oil, the difference between these two is oftentimes their profit margin, right? So if demand increases for the refined product and the input cost is going down, which is what we've been seeing happening with crude oil, then that profit margin for refiners is increasing. So one of the ways that we see that or look at that profit margin for refiners is we talk about what's called the crack spread. Cracking refers to the chemical mechanical process of splitting crude oil. It takes a lot of heat to do that. Crude oil into its products, its distillate products, right? So light gases, and then gasoline, and then other distillates, and then other petroleum products. All of that stuff comes out of the cracking process. So that's why this is referred to as the crack spread. So the crack spread is the difference. Let me just draw this really quickly. And this is not the crack spread. This is simply kind of a picture of what it kind of looks like. This is heating oil and crude oil. But input cost, so I'm going to label that as IC minus output price equals crack spread. Crack spread, okay? Input cost minus output price equals the crack spread. So what are the inputs into, say, for instance, the crude oil, heating oil, crack spread? Well, it is crude oil coming in, right? And heating oil going out. But we got to come up with an apples to apples comparison. So I've built that already. Let me show you how I built that. I'm going to go here from my single grid to this crack spread from crude oil to heating oil. So what I did is I just created a mathematical relationship. I wanted to put these into a common denominator. There are, okay, so in a barrel of crude oil, there are 42 gallons of heating oil. Same thing with gasoline. 42 gallons of heating oil, 42 gallons of gasoline in a barrel of crude oil. I had a 1995 or 1996 Chevy Suburban that had a fuel tank that was 42 gallons. It held essentially the equivalent of 1 barrel of crude oil in its fuel tank. And it was a beast to fill up, especially when gas prices were expensive. But by doing this, 42 times heating oil minus crude oil, we're getting to that crack spread. Input cost minus output price, okay, is going to give us this crack spread. So here's the relationship. I'm going to draw this in. When this is rising, refiner profits are increasing. When this is falling, refiner profits are falling. What's going on right now? That crack spread is getting wider. Input costs are lower. Output prices are getting higher. That is giving us an indication that refiner profits are potentially increasing. So the thing that I wanted to illustrate here simply is that futures contracts and the futures market are more than just trading those, E-minis, or trading the crude oil contract, or trading the gold contract. That's a great help, and the ability to trade the products themselves is important. But the ability to use and understand why these futures contracts are important for us as technical indicators, as economic indicators, as measures of certain relationships is also important as well. So this is something that I think, in this particular class, especially when the market is kind of moving sideways, even though it's moving a little bit, right? Then that is something that is important to pay attention to. So you can create your own. This is what's referred to as a one-to-one. Just so you know, this is a one-to-one crack spread. Oftentimes the typical crack spread, this is just a simplified crack spread. Oftentimes what you'll get is a 3-to-1 crack spread, which is 3 barrels of heating oil, 2 barrels of gasoline to 1 barrel of crude oil. So that's one of the relationships, that 3-to-1 crack spread. You'll see other types of crack spreads out there. Now, if you really want to get derivative, there are trading products that trade those crack spreads, and there are ways to trade the crack spreads. This relationship, if we were to do, say, for instance, a pairs trade, meaning short crude and long heating oil, would be one way to do that. That gets into some additional risk, because that spread, whenever you're talking about pairs trading, and we have pairs trading as a potential, and we'll talk about it one of these days, not today. Today is not that day. One does not simply walk in and start trading pairs trades on futures contracts, but we do have that pairs trading potential to where we could put in /HO on one side and /CL on the other side, and come up with that relationship, and you could buy or sell that pair and that relationship, and you can create the characteristics. We'll talk about this one day, but not today. I just wanted to give you a little bit of a taste of that, but that kind of gives you that sense of some of the ways that you can use this. By the way, a couple of things. We've got a feedback survey there. Remember, you can follow us on Twitter. You can follow, or on X, at Ben Watson CS, at Mike Fairborn CS. Remember to check out our webcast schedule over here at schwab.com/coaching, and our Trader Talks webcast here. If you want to come back in here, crack spread. I think I've got a couple of webcasts in here where I talk about that. Right there, crude oil and crack spreads. That was about not quite a year ago that we talked about that. And so that's, again, another way you can get that information too. So, by the way, how far could I travel with a barrel of gas in that tank? That was good for about, let's see, I was getting about 7 miles to the gallon in that Suburban. So you do the math. All right, guys, let's pop back over here really quickly. And just a quick reminder of everything that we've talked about today. We talked at futures contracts. We talked about some example trades. We looked at some of the other ways that you can use futures contracts. I was listening to some Joni Mitchell this morning, if you saw me on the Schwab Network. By the way, Schwab Network brought to us by our media affiliate, Charles Schwab Media Productions. I was on Morning Movers this morning. I'm going to be on Trading 360 with Nicole Patalides coming up here in just a little bit, and then on Next Gen, investing with Alex Coffey and Jenny Horn a little bit later today. Guys, thanks very much. Thanks to Michael Fairborn for helping out. Thanks to our great production staff and everybody else, all the reviewers and everything else that behind the scenes that helped to make this webcast and all of our webcasts great. Hope to see you guys again very soon, and we will see you again very soon. Take care. Bye bye.